Great. I think we have spent a lot of time on the engineering and exit side. Now let's go to the navigating side, which is let's talk about aspects of the deal,
Mm,
right? So I want to start with the most important thing, which is what kind of is the center of any deal, which is valuation. So Hans, I think coming to you, uh, again, I think for most founders, they're not valuation experts, right? Yeah, I mean, once you raise venture rounds, you kind of learn a little bit about, how kind of people think about it. Let's say a founder's gone through the experience, like an acquirer has reached out, they're kind of in the process, and they're now kind of starting to try think about valuation, whether does the deal make sense? How should they think about how acquirers will value their companies, right? Because
yeah,
that also drives a lot of thinking in terms of timing, in terms of, hey, is this the right time or not? What is everyone getting out of the deal, right?
That's a great question. And I think first-time entrepreneurs run into the mistake of overvaluing. They think it's the right thing to do or the better thing to do. But I think there's now enough knowledge, collective knowledge, to look at what the multipliers should be for certain evaluation, or for certain valuation for the company. And that's, again, part of this continued education for the founders, for their vertical, for their business, for their market to figure that out. But for, the revenue multiple is common for most SaaS and growth companies, right? So it's like for high growth, 30 to 40% growth year over year, you're hitting I don't know, like a 6 to 10, 15x ARR for that. And then for the subscale, the ones that aren't really growing, sub 5 million ARR, 1 to 3 x multiplier for ARR, right? Um, so it all depends. It depends where you are. And um, I mean, there is math to this, and you can figure out the math, but the math isn't the say all end all. You have to look at the market and see what the market is like. And then sometimes you can look, if you're looking at to be acquired, sometimes the buyer is going to tell you, like, sure, like, I'm so interested in your company, I'm so interested in your product, I want you now, I want you yesterday. So of course that could increase the multiplier a bit. Um, for larger, more mature companies, it tends to be more on the profit EBITDA multiples. And, I'm probably not going to go into that, but the math is there, and you could figure out that out. But I think where it also hits, like, if you're a new AI company and everybody's a new AI company and there's really no revenue, and or for deep tech or whatnot, it's like 1 to 3 x multiplier, because it's not tried and true. And then the valuations around your IP, your assets, right? Like your technology. And that becomes kind of a, you know, uh, straight negotiation from, the founders themselves. So I would say the biggest thing is don't overvalue yourself. Look at the market, look at comparables, and kind of see where you are and see how much money you're planning on raising, to kind of undervalue and over deliver, always probably the best thing. There are certain market types where the market is low on cash, but you're raise as much money as possible at whatever valuation you can get at the time, and then continue to prove out your concept, knowing that you can actually do that. Last thing you want to do is again, to overpromise, underdeliver. Um, and what actually truly affects your valuation, your growth rate, your predictability of growth rate, looking at your NRR, looking at your sales pipeline, looking at the market itself. Obviously, there are certain things that we can't predict, but being able to predict in your market what you're in the books for this year, in the books for next year, and hitting those and showing that you've been hitting those the last year and the year before, always fantastic. And then, back to the buyer appetite, like, if it's high, if it's there, it'll impact your valuation, but also who's buying you, right? So we've talked about strategic buyers and financial buyers. Strategic meaning like other companies, larger companies, Amazon, Google, et cetera, buying you. They're willing to pay a higher multiplier for your company because it's going to fit their needs, their strategies more immediately. And then the financial buyers, lower multipliers. They can buy in park, right? It's not necessarily a necessity. It's not a massive need, but it's a nice value add to their portfolio. So that also is going to play a role in terms of your multipliers. And then, Madhu mentioned this, the team is always going to be important in terms of the valuation. You're going to have, multi startup founders, they're going to, you're going to be valued more. You're going to have more domain expertise along the way. And that's huge too. Um, the one thing I want to mention is, and I think, I kind of mentioned, but like the the issues when you're thinking about valuation and people just kind of get into it and they kind of lose their mind a little bit. You're focusing on revenue and not profitability, and that's not a good thing because in a due diligence format, that's going to be uncovered. You're ignoring some of the churn that's happening within your company because you're thinking that you're going to bring in, more business, and that you got to look at these things, and you never want to overvalue your business because that's definitely shooting yourself in the foot. Uh, and are you going to be competitive next year? Are there new entrants in the market? Is your competitive positioning changing year after year because you're fairly slow at, applying artificial intelligence, let's say, to your solution? So these are the things that you're going to have to constantly think about when in that format.
And then I think one kind of follow up on that, which is a point of personal curiosity for me, is how do these acquirers value companies in case of acqui-hire situations, right? Where you are basically just acquiring a team, right? And how do
Yeah.
they kind of
So
think about what do the investors get? What do the founder get? What do the employees get? Like, what have you seen?
Yeah, so I mean, there is definitely a math around this. So like, engineers are it's kind of funny to put it this way, but engineers will cost a certain amount. Business folks will be a certain amount based on salaries, et cetera. In fact, one of the companies I worked at, we got acquired by Google. It was mostly an acqui-hire. The company was really cool product. We ended up selling into basically the Chrome team, and it was a nice add-on to Chrome extension, et cetera. So the value there was based on, get rid of, as sad as it sounds, but you get rid of the employees that are not really necessary. You value the employees that are there. You value the founders, obviously, because they're going to basically take over this project. That's going to be its own project within a subgroup within a larger company. And then, you cash out some of these employees that are not going to be part of it. And then the ones that are coming in, you give them some the founders obviously with a bit of a golden handcuffs for a couple of years, and then some of the engineers that were instrumental in developing the technology, they get a nice initial payout with a good salary to that acquisition, stock grants, retention bonuses, etc. And then they acquire the IP, they acquire the technology, and you become part of that larger company. In this particular instance, we became part of Google. Um, I was one of the people that exited and didn't jump in. I was a business guy, didn't really need me. So I was heading business development at the time. So it was mostly the engineers, and that's usually where the most of the value comes in.